Alright, just finished the Berkshire meeting. What was your favourite part?
I don't know, it was interesting. They talked a lot about...
Hold on a sec. This whole journey started on Wednesday. We packed our bags and headed to the airport. We were heading to the small town of Omaha, Nebraska, where once a year 40,000 people come to listen to Warren Buffett and Charlie Munger answer questions and discuss a variety of topics from the economy, value investing, and geopolitics.
And they know they have to get along with each other. Either one can destroy the other.
Anyway, this is us after staying up for 26 hours so that we could sleep on the plane. It didn't work. Well, at least the jet lag provided one advantage. When we woke up at 3 a.m. to line up for the meeting, it felt like it was the middle of the day. We rushed inside to get a good spot to sit. Oh look, there's Monish Pabrai. We got comfortable in our seats and were ready to hear from two of our favorite investors.
As AI and robotics continue to advance, what do you believe will be the positive and the negative on both the stocks market and society as a whole?
This year's annual meeting was, in my view, one of the best yet, as both Warren and Charlie actively answered a huge variety of topics, from artificial intelligence to geopolitical tensions between China and the US. And they also provided a great deal of insights on how the average person can become a better investor. The first big topic of the day was artificial intelligence and its impact as it grows exponentially over the coming years.
It couldn't tell jokes. Bill told me that ahead of time and it prepared me. And it just isn't there. You know, with things like checking all the legal opinions, you know, since the beginning of time and everything, and eliminating all the it can do all kinds of things.
AI is advancing quickly, and even at the ripe age of 92, Buffett can appreciate how the development of ChatGPT and similar technologies are likely to displace a large number of jobs in a very short period of time. A study by Goldman Sachs estimates that 2/3 of jobs in the US and Europe will be automated by AI to some degree, and as many as 300 million jobs globally will eventually be displaced. While the study shows that jobs in practically every industry will be affected, the jobs most likely to be impacted first are office and administrative jobs, followed by legal work, architecture, and engineering. Of course, while AI is likely to provide a significant leap in efficiency in these areas, there are some reasons to be concerned.
When something can do all kinds of things, I get a little bit worried, because I know we won't be able to uninvent it.
AI is going to change the world in ways that we cannot begin to imagine, and there will be no way to go back. While he acknowledges that it's not exactly the same, Buffett refers to the invention of the atom bomb as a similar situation.
We did invent, for very, very good reason, the atom bomb in World War II, and it was, it was enormously important that we did so. But is it good for the next 200 years of the world that the ability to do so has been unleashed?
Towards the end of World War II, a team led by J. Robert Oppenheimer developed the world's first nuclear weapons that were ultimately used twice by the United States against Japan in 1945. To this day, they remain the only two times that nuclear weapons have been used, but the technology that was created 80 years ago is now available to many nations and has permanently changed geopolitical tensions in a meaningful way.
You have the two superpowers of the world, and they know they have to get along with each other. Either one can destroy the other.
Buffett goes on to explain that because both the US and China have nuclear weapons that they could use against the other, each can get away with being a bully because the alternative is mutual destruction. So the invention of nuclear weapons essentially created a game theory situation. Game theory is a type of mathematics which studies the interactions between rationally acting parties. Imagine a situation where you and your friend are both arrested for committing a crime together. You are being interrogated and there are 4 possible outcomes. If you both remain silent, you will both walk free. If you talk and your friend remains silent, you'll get a lighter prison sentence than your friend. But if you both talk, then you'll both serve the same prison sentence. Knowing all 4 outcomes, the best decision for both of you would be to remain silent so that you don't go to prison. But because you don't know what the other person is going to do, the most rational option is for you to talk. Of course, if both you and your friend both choose the most rational outcome, then you will both go to jail. The same sort of situation could be said for the US and China's China's geopolitical situation. It's in the best interest of both parties to get along, but with the looming tensions of potential nuclear war, both parties can get away with bullying each other without massive retaliation. And this, of course, has led to progressively rising tensions.
I think that tension has been wrongly created on both sides. I think we're equally guilty of being stupid. If there's one thing we should do, it's get along with China. And we should have a lot of free trade with China.
Buffett also commented on why he decided to sell his position in Taiwan Semiconductors and whether it has anything to do with concerns about China.
Taiwan Semiconductors is one of the best managed companies and important companies in the world. And there is not, and I think you'll be able to say the same thing 5 or 10 or 20 years from now. I don't like its location, and I've reevaluated that.
While he didn't explicitly say this, I think Buffett would put the China-Taiwan situation in the basket of important but unknowable. To him, the success of the investment in TSMC hinges too much on whether Taiwan is allowed to continue operating independently from China, something that Buffett can't measure, and therefore he would rather allocate his capital elsewhere. Just before I get to the next clip, my buddy Brandon is going to tell you about our Berkshire sponsor.
Hamish and Brandon's Berkshire Bonanza 2023 is brought to you by Seeking Alpha. Try Seeking Alpha Premium today to access Seeking Alpha's rating system, valuation breakdowns, 10 years of financial data, unlimited news and analysis articles, plus have earnings call transcripts, investor presentations, SEC filings, and press releases all in the one place. With the suite of tools that come with Seeking Alpha Premium, you can be confident no matter what company you're looking at, you'll be able to get up to speed fast. But the best thing about our partnership is if you sign up with our referral link, you can access a 14-day free trial of Seeking Alpha Premium. So go check them out, give Seeking Alpha Premium a go for yourself, and now let's get back to it.
I think one of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea.
The idea of reducing risk by spreading your capital across a wide range of stocks isn't something that has ever made sense to Munger. His personal wealth has always been held in a handful of companies. And while Berkshire Hathaway is now a fairly diverse collection of wholly owned and partly owned businesses, for much of its history, it's had a concentration of capital invested in just a few good ideas.
It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst.
Munger believes you should only be willing to invest in good ideas, even if you can only come up with a handful of them. The alternative, of course, would be to dilute your good ideas by holding a bunch of stocks that you have little conviction in. And while modern corporate finance suggests that this reduces risk, Munger actually thinks that this increases it.
Some people can't tell their best ideas from their worst, and in the act of deciding that an investment already is good, they get to thinking it's better than it is. We're not so smart, but we kind of know where the edge of our smartness is.
Knowing your area of expertise is more important than having an opinion on everything. This is the idea of circle of competence. There are thousands of companies you can invest in, and you only need to be right on a few to do extremely well, which means you're more likely to do well in investing if you stick to the industries or business models that you have an edge over the average investor.
We're learning all the time how consumers behave. I'm not going to be able to learn the technical aspects of businesses, but that'd be nice if I knew it, but it isn't essential.
Related to the topic of circle of competence and investing in what you understand well, Buffett admits that he often doesn't understand the technicalities of the businesses he invests in. And while it's helpful to understand the technicalities of the business, it's not what is essential for you to do well over time. Rather, it's more important to understand the characteristics and patterns of businesses that sell products consumers desire highly.
And so C's was a sort of breakthrough, but
this kind of thinking became a critical part of Buffett's investing philosophy after acquiring See's Candy in 1972. A business that seemingly sells a product that would be easy to replicate by competition has been able to build a strong brand reputation and allowed them to continually raise prices for many years. And Buffett's focus on consumer behavior over understanding the technicalities of the product has led to his biggest investment today.
we've got a business at Apple, and I don't understand the phone at all, but I do understand consumer behavior.
Buffett isn't interested in trying to create some formula or modeling out financials into the future, but rather identifying patterns that good businesses have used to maintain their competitive advantage.
Berkshire owns about 94 million shares of Paramount Global as of the last published data. This asset-rich company is disappointed on recent quarterly earnings reports and just this week slashed its dividend by 80%. How do you see the streaming wars evolving, and do you still have conviction in your investment thesis?
Buffett was once again asked about Berkshire Hathaway's investment in Paramount, one of the legacy media businesses trying to transition in this modern streaming era.
I will say this, it's not good news when any company passes its dividend, or cuts its dividend dramatically. And the streaming business is extremely interesting to watch because there's people love to use their eyeballs being entertained on a screen in front of them or a phone or whatever it may be. But there's a lot of companies doing it, and you need fewer companies or you need higher prices. Well, you need higher prices or it doesn't work.
Buffett points out that the streaming business is extremely difficult because there's lots of companies competing for your attention and a significant subscriber base is needed for it to be done profitably. Netflix, the only company that's able to do streaming profitably at the moment, only reached profitability just a couple of years ago after already gaining over 200 million global subscribers. So streaming will continue to be a very tough business unless competition decreases and prices can go up.
The eyeballs aren't going to increase dramatically, and the time they can spend is not going to increase dramatically, and you got a bunch of companies that don't want to quit. And
Disney, Warner Brothers, Paramount, and a number of other media companies are currently throwing billions of dollars to chase subscriber growth and to become profitable in streaming. And as long as none of these media companies quit, it's going to be a very difficult business for everybody. The ideal outcome for a business like Netflix is that some media companies bow out of the streaming wars. You'd still have a wide number of media companies producing movies and television shows, but if a few of those companies bow out of the streaming wars, then the distribution of those shows would be concentrated in a few remaining survivors who could then use their competitive position to raise prices over time and make the business economically more sound. What's interesting is that despite Berkshire's investment in Paramount, both Buffett and Munger seem pessimistic about it as a good investment.
I think the movie business is one tough business.
yeah.
That's my view.
We just touched the surface on some of these topics, and over the next few weeks, I'm going to be doing a deep dive on more of the clips and topics of discussion from the Berkshire Hathaway annual meeting. So if you want to stay up to date with all of that content, the best thing you can do is go below and hit that subscribe button. But for now, I'll see you in the next video.